This is Benzinga Live. Spencer Israel and producer AB. What's up, everybody? How we doing?
Someone told me buy high, sell higher.
Let's get Matt Hammond on the show to talk some IPOs. Jake Wojacek from Trend Spider. We have
breaking news. What is up, everybody? Shout out Rebecca Black, because it's Friday. Hope everyone's having a good Friday so far. Welcome to everyone joining us from Benzinga All Access. Hope everyone enjoyed that great content brought to you by Mr. Zunaid himself and Money Mitch, of course, helping out. Let's go ahead and get my Benzinga Pro pulled up, do a quick run through of the overall markets, and then a quick agenda rundown for the day. We should be joined here in about 5 minutes by Mr. Tim Quast from Market Structure Edge. What up, Manier? What up, BZ Films in the chat? Who's that? Who's BZ Films? Is that us? Tim Quast should be joining us about 12:15. At 12:30, Eric ES Invest from Twitter will be hopping on with us. Love chatting with Eric, seeing what he's trading, seeing what he's been up to. Major indices are higher following a Wall Street Journal report suggesting the Fed may be debating the size of future rate hikes. Interesting. Yeah, I think we're getting to a point now where, I mean, the next 2 rate hikes might be baked in at 75 basis points, but beyond that, the Fed may start to be more data dependent here, and that's kind of something I've been calling for, just saying, hey, look, I think we may be closer than some people realize to the Fed being essentially forced to not, I wouldn't even say pivot's the right word, because pivot implies, right, going from hawkish to dovish. I don't think pivot is necessarily what we're looking for, what we need to happen. I think we just need some sort of, for them to say, okay, we're still going to be hawkish, but if instead of being on a 10 on the hawk scale, we're going to be at a 7 or an 8, the markets will respond well to that. And then I do foresee that happening here, if not, in November, in December, at some point in the next couple months. Something I've been watching today, Netflix. We know Netflix, you can see right here, we're looking at a 5-minute chart. We can look at it on a daily too. But we can see the earnings reaction, of course, to the earnings report. Netflix traded up, went from about 240 up to 278. But what's interesting here is we've seen this over the past, even last earnings season too. Some companies that did better than expected got a nice bounce in the stock, and then ended up giving those gains up. Netflix is trading pretty well after this earnings report, up another 5% today. I mean, if Netflix, and we'll go back to the daily chart here, we know it got below 180 here. It was probably a little bit, or definitely a little bit oversold. We're getting some action back up here. We could fill this gap all the way up to 340. I'm not, completely bought in on Netflix here. Like, I'd still rather be long than short the stock. But the stock has made a huge move now at this point from 170 up to 280 in a couple months. So I wouldn't be surprised to see some sort of a pullback here in Netflix. But again, I don't mind the stock here. Apple, let's check in on Apple. Stock trading about $145 right now. Of course, we have earnings coming out in 6 days, Thursday, October 27th, after the market close. Yeah, I mean, today's a good day so far. The overall market, Qs pushing higher. Looks like we have given up some gains in the last 10 minutes or so. Yeah, we're looking at a 5-minute candles here. You can see 2 consecutive red 5-minute candles in a row, bringing us back down to the 271 level. As always, let me know in the chat what stocks you guys are watching, what you guys are trading. Again, Tim Quast will be hopping on with us here in a couple minutes. Hopefully, we'll be talking about some market structure, some supply, demand. One trade idea that I gave out on the show that I took, that I made some money on today, I wonder if anyone else took it with me, was puts on Twitter. Twitter down 4% today. I was talking about this with Zunaid yesterday. I do think there's a lot of alpha here in play. I mean, I was saying the opposite when Twitter was down at around $40, saying, hey, I mean, 40 to 54 is some pretty decent upside, 30% or something in this market environment, right? Like, you're going to take that. You're going to take 30% upside trade in that market environment. But when Twitter got up to above 50, $52 or whatever, and it the market was basically treating it as a done deal. Here's what we know about the deal. Elon's trying to get out of it. Elon doesn't have an easy way out of it. Twitter's trying to force him to complete the deal because they know he's overpaying for it. But I still think it's not a done deal. I don't think it's likely that the deal falls through. Like, I'm not saying I think it's a 70% chance that the Elon Musk Twitter deal falls through. It's probably more likely the deal goes through than not. But I don't agree with the market kind of pricing it as like a sure thing. And I do think because of that, buying puts, say I got lucky because I bought some puts that expired today and the stock just happens to be down 4% today. I honestly don't even know why. Probably the layoff news that they announced they were going to lay off, or Elon said he's going to lay off like 75% of the staff if the deal goes through. That could also be a way that he's trying to get them to maybe reconsider the deal, right? Because if you're Twitter and you have, your workforce and you're like, oh my God, if we go through with this deal, 75% of them are getting fired. I don't know. Maybe that makes them think, okay, maybe we need to hold on to this company a little bit longer so we can protect these jobs. I don't think they're really going to think like that, but potentially it could be what Elon's trying to do. No clue. But again, I do think there's more alpha and more potential return playing the downside of this Twitter deal. And something I was looking at yesterday was the November monthlies. I believe they expired November 18th, like some of those puts, because you can buy $40 puts and know that, okay, if something goes wrong with the deal in between now and a month from now on November 11th, the stock's going to drop a lot and very quickly, which is what you need when you're holding puts. You need A, the stock to move in the right direction for you, and B, for that move to happen quickly and violently, which is, and similarly, we gave a trade idea out like this with DWAC, where, I said like, okay, buying long outdated puts on DWAC had more alpha than playing on the long side because you had a potential with a stock like this to have like a catastrophic, dramatic, violent move in one day where the stock's down 30, 40% and the puts just skyrocket by like thousands percent. And that's how it works. All right, guys, I'm not seeing any tickers flying in the chat. Let's try to be better on this Thursday. I know you guys are better than that. We don't get to throw our quarterly pizza party unless we get some good participation in the chat. I have a different take on Twitter. Twitter is owned by the intelligence agencies. They don't want Musk to find that out. That sounds like some like QAnon type shit, Jay. I don't think there is a case to be made that the government, like, not the government per se, but the courts forced the deal to go through, and then the government comes in and like divests Twitter for national security reasons. Because you could argue having Twitter be privately like held and run by one person could be like a national security issue, I guess. I don't know. I don't think if I would have to disagree with that, because I think if anything, like I think I've gotten the most or a large amount of information from Twitter that is like anti, I guess things you wouldn't see on mainstream media that really go against if the intelligence agencies can control, like, I don't know, maybe they control all forms of media and information, but they controlled any, it'd be like the way mainstream media operates. Whereas on Twitter, like you can find people that are actually like calling out the, how mainstream media is operating, or the CIA did this or the FBI did that. I don't know. I mean, who knows? Thoughts on JetBlue? I did. So I don't know. I haven't looked into enough of these to know the like actual company to company where these stand. I mean, clearly looking at this chart, considering JetBlue's stock is where it was at in March 2020 when the whole economy and world was shut down from COVID-19, I'm going to take it that the company's not in a great position compared to other airlines. I've gave this thesis on Jets before, which is just the global U.S. Airlines ETF. So its top holdings are different airlines, Boeing, Airbus, etc. I do like this, like on the long side, long term. Actually, I should rephrase that. I don't necessarily like holding this just long term because of the fact that I think airlines across the board just aren't the best stocks to own in terms of like profitability, returning value to share. I mean, you look at Southwest here, was making all-time highs in January 20 or December 2017. Even when the stock market was making new all-time highs right before COVID, Southwest wasn't. Same thing can be said for, American Airlines. Like well, actually, American Airlines was making no. See, that was back in 2018. Look at where the stock was. This is when the S&P 500 was making new all-time highs right before COVID in February 2020, and American Airlines is down like 50% from its highs. Like a lot of these stocks just have not done well. But with jets, that like the U.S. government's not going to let all these airlines go out of business. So with jets, I think it can be a good thing to swing, and I think we're a little bit overextended on the downside here. So I wouldn't mind trying to play jets from like, it's at 1672 right now, start a position in this now, and then try to get 10, 20% out of it, knowing, all right, these companies aren't going anywhere. Are they going to be, are their stocks going to be appreciated in value steadily for the next 5, 10 years? No, I don't think so. Probably not. I'd rather own and hold other stocks, but I would be willing to trade this Jets ETF for a nice little swing trade. Yeah, and I don't know, and I think, I mean, it opens up like a whole can of worms, right? Like talking about how big tech and these social media companies, like I am in favor, and there's support for this on both sides of the political aisle. Reform to Section 130, essentially that big big tech companies like Facebook and Twitter shouldn't be able to, like you're saying, Jay, have the power of being a publisher, but then having the freedom in terms of not being liable. Like a publisher, take for example, the Miami Herald is a publisher. So if as a publisher, Miami Herald, regardless of if someone from Miami Herald writes an opinion piece or it's some contributor, Miami Herald can then be held liable for what it prints and publishes because it's a publisher. And the distinction there is a forum is essentially a free place for communication, kind of the town hall method of communication where everyone has a say. That's a forum. And a publisher chooses what goes out there. And so a publisher can be held liable, right? Sued if something is found to be untrue and defamatory, all this stuff. So Twitter, Facebook can act as a publisher in that sense, where they can censor certain people, but they get the freedoms of being a forum. They say, oh, we're not a publisher. Look at Section 130, which was a law or regulation kind of in the .com 90s era to help protect like different websites popping up from getting sued, from these things. So basically, I am in favor of some reform there because I don't think that makes sense to be able to have the publishing power. Now, on the flip side, and I think Elon's going to figure this out pretty quickly if he buys Twitter and starts running it, is that it sounds a lot better and easier to say like, okay, we're going to have a free speech absolutism policy on the platform, right? I mean, you start getting very quickly, I think, into some potential problems there, right? And I think for the COVID specifically, I think it's hard. Like I think it's hard because I'm not in favor of censorship really. Like even I think in extreme cases, like I don't know. It's tough because like what are you gonna do about someone like on Twitter? Like if Elon Musk is running Twitter and trying to do a free speech absolutism policy, and some like 15-year-old kid is getting harassed to the point where they're suicidal, are you going to say, okay, well, we're not going to censor any of this bullying or harassment because that'd be, a violation of someone's free speech? Or do you do it, and then all of a sudden the free speech, then you're just as bad as someone censoring someone saying someone goes at COVID, right? I think there's a reason, right, that Twitter and Facebook do the types of content moderation that they do, and it's not you know, I really, really don't think, for the most part, it's some sort of like nefarious control the message from the left. Honestly, I think that in general is kind of a it's gonna get bad. Andio says when Elon owns Twitter. I think Twitter is gonna be kind of fucked when that happens. If because like I said, I think if Elon does go free speech absolutism policy on Twitter and people are you know like the neo Nazis are coming out of the woodworks and shit, like you're gonna run into problems. And Elon's either going to back down on that and be like, all right, yeah, we are going to go back to some sort of form of content moderation. And then people might be pissed where they're like, all right, so you went through all this stuff to buy this and it's going to be just like, you know, just like it was. I mean, I don't know. Again, I do think that there's a reason, right? Twitter, Facebook, all these people know that content moder it's not like a super popular policy to censor certain people, whatever. They do it, I think, to try to save their own ass. In terms of COVID, I do think there probably was some fear from the big companies that like, and again, now we know a lot more about COVID, so it's easier to, I think, in hindsight, to say like what was right, what was wrong. But if you're running like Facebook or Twitter and you know you have these videos that are going viral that are asserting, and look, we can debate all you want about COVID severity, which policies were reasonable, which policies were wrong, yada yada, but in terms of like factual, you know, discourse, videos and shit that were saying like this whole thing isn't real, it's made up and could potentially put people at risk. And look, again, like I don't want to argue about COVID or responses or whatever, but if you know, I don't know, like if I were running Twitter or Facebook and I were in charge of it and I saw just even a chance that like we could be held liable and someone saying, hey, look, you know, my grandma watched this video on Facebook that said COVID wasn't real and then she died of COVID. Facebook, what are you going to do about that? I kind of get it. And again, I don't agree. Like, I'm more in favor of let like bad ideas go out there and then let people debate them and argue against them and point holes in people's logic and prove how like wrong, you know, some like, and I think that honestly too, with even something like, you know, like racism and Nazi, like if someone wants to come on here and try to argue with me that, you know, Hitler was right or something, sure, I'll argue with you all day and show you like how dumb of an argument it is, rather than saying I'm not going to give any platform. I don't know, maybe I wouldn't want to give a platform. I have no clue. We've gotten on a people are foaming at the mouth to spout the worst. I feel like anything better than the world, I don't know. We got off topic. Let's get back to the market. You don't even let us swear sometimes in chat. Frick. You can say frick. You can say whatever you want in the chat. People have already made up their mind both ways. Facts don't seem to, yeah, 100%. I think that's I mean, not a new idea at all, but like the whole idea of like tribalism, people feeling like they're in like an in group against another group, and it's like no matter what, and it's just like how do we, not even just as a country in America, like get away from that, but just like around the world and realize like, hey, at the end of the day, right, like someone might be a Democrat, someone might be a Republican, but we're all at the end of the day way more similar than we are different. We all want the same things. We all want the best for our family. We want security. We want to make sure we know we have a little bit of money, maybe to be able to travel and buy nice things. We want to see the people we care about be happy. Everyone wants the same thing. Confirmation bias. What do you think, Walmart? I like Walmart stock. I think it's like I mean, it's not going to be like a crazy growth stock, I don't think. I like how Walmart does seem to be investing a lot in its like app and technology. It's trying to take on Amazon with some grocery delivery. I just don't know, like outside of it being like a safer stock in your portfolio to diversify out of some like more growthier names, I don't really know what you'd be like using it for, unless you're just trying to trade it, which I don't know if it's like the best thing to trade like that. You know what I'm saying? Just because I don't know if it moves that much. Yeah, I mean, honestly, I think the biggest problem I've made this point before, and it can be applied to sports teams, politics, investing, whatever it is. But like, instead of, I use example of Tesla a lot. Like, it's like I feel like Tesla, like people are invested in Tesla. Like it's like as a Tesla shareholder, I should want to be critical of Elon Musk. And like same thing with like if you're a say you're like a Republican, like you should want to be critical of the party to like want to get better. If you're a sports team, whatever. If you're just blindly saying like, oh, Tesla's the best thing in the world, I'm a shareholder at Tesla, it can't get better because it's the best thing in the world, you're gonna overlook some true things that you may need to improve. And I think you can apply that anywhere. So yeah, I mean, I think just getting away from that, Zen bullish, talking about different false equivalencies, confirmations bias, 100%. Twitter, oh yeah, and that's my biggest take with Twitter. If this deal does go through, Elon's going to learn real quickly, like, oh shit, some of these policies were put in place for a reason. And yeah, Twitter, who do I bet for in football? I need metaverse poker chips. Wait, are you betting on like a metaverse football team? Or are you betting on a football team in real life that will get you coins in the metaverse? And are you talking about soccer or American football? Because I know you're not in America, so when you say football, it could mean different things. But yeah, well, and also I do want to say this, and I see our first guest hanging out in the back. Yes, Invest from Twitter. Excited to see what he's been chatting about. The last like I guess point to our conversation about kind of like politics and big tech. The whole idea, and again, like there's some truths in it, and there's some I don't think like. All right, let's start with facts. For the most part, a vast majority, like 90% plus of people that work for the big tech, social media companies, Facebook, Google, YouTube, you name it, are like Democrats. I don't think those companies are out there trying to hire only Democrats. It might be one of those things where like statistically most college graduates lean that, whatever, or it's a California Silicon Valley thing. I don't know. But the whole idea that like there's this, like nefarious want to like control information that promotes the Democrats it's just not true in terms of like on an empirical data level from social media companies. So this is from the Register and a study from New York University Centers for Social Media. And this has been replicated many times. This is not new. I just saw this because it came out 3 days ago, Tuesday, October 18, 2022. YouTube loves recommending conservative vids regardless of your beliefs. And you can literally try this on your own. I've done this as an experiment on my own. You open YouTube in like an incognito window without being signed in. And you start on like a very neutral video, and you just keep like skipping through it and going to the next recommended video. You get to like QAnon videos very quickly. It's like crazy. And because and I was reading about the algorithm and the psychology behind it, and it's because the I don't know what the right word is. I guess like the sensationalism of a lot of these right-wing conspiracies, right? Like the Democrats being like it's all this. It's all so kind of riveting that it really like locks people in. Like, holy shit, these people are like, doing this to kid, and they get really like locked in. Whereas some of the stuff on the other side isn't as, I don't think, capturing from like a human psychology standpoint, right? They're like, oh, here are the adverse effects of capitalism, and like that doesn't have the same capturing effect of look at what these people are doing to like little kids, So it's like, I don't know. I think the more you research that phenomenon of of how algorithms work and shit, the less that argument holds up that Twitter, YouTube, Google, Facebook are all, 100% trying to coerce people into believing a certain way. Watched a soccer game with the sound off at the same time as an NFL game, and the soccer game looked like a bunch of elementary school whining divas, bad actors. Yeah, I mean, you figure out how to fix the flopping problem in soccer, you'll make some money. I think they've made some progress on it the past few years, but I think it's still definitely an issue. It's an issue in all sports. And I mean, honestly, Brookings is garb. I agree. I mean, Brookings Institute is like well, it's funny. The people on like the right are like, oh, they're liberal. People on the left are like, they're conservative. I don't know. I don't think they're not the ones that think tank isn't the one that did the study. It was New York University, right? I don't know. I just had it up. Let me pull it back up. All right, let's get to our yeah. It was highlighted. The study wasn't done by Brookings. They just wrote about it. It was done by New York universities. And again, I mean, if you're, like, oh my God, New York University, they're liberal. Of course they're going to put, sure, I guess. Like, I don't know. All right. Again, let's get back to markets, get back to stocks. I'll get my Benzinga Pro pulled back up, and let's go ahead out there and or go ahead and pull up our first guest, Mr. Eric at ES Invests from Twitter. Let's give Eric our very special intro. See how Eric's doing today. See what he's been trading. What up,
Yo,
Eric? How you doing?
What's up, man? How are you?
Good. Friday shows. Friday, we typically have a little bit lighter news days on Wall Street, so we sometimes get off on tangents here on Friday shows. I apologize.
I actually was really enjoying that. I think like those kind of dialogues are super important because like I'm 31 now, and when I was in my mid 20s, I legitimately had a very different perspective on the world in terms of people's motivations and how things worked. So I honestly think the fact that you even have that dialogue here is important for people because I definitely have become, I still wouldn't consider myself like 60-year-old tinfoil hat level, but I am definitely growing more the tinfoil hat side of things. So it's an interesting dialogue to listen to.
Yeah, and I think honestly, I mean, like I love talking about the markets and stocks and stuff, but I think one thing, like, in my background's kind of more in media, like I went to journalism school and stuff. One thing that just frustrates me so much about like the world we live in is I feel like 99% of the discourse you see like about any given subject, like whatever, it's just so like, all right, we could be having a way more like intellectual, like better, productive conversation
Absolutely.
about this. And so that's
Have
something I
you
try to bring. What's that?
have you read Dave Lauer? He's a dude I've had on my channel a couple times. He used to be a market maker, but he has like a personal vendetta. That might be a little dramatic, but he has some issues with Facebook. And he actually wrote a really fascinating paper on Facebook. It's called something about Facebook's conflict-driven model, and it's exactly what you're talking about, where they drive engagement by essentially pitting people against one another so that they fight with each other online. More time on platform, better for Facebook. And he has a bunch of like very interesting data points that he integrates into the study, but it reminds me exactly what you're talking about, that we've become so entrenched that you literally can't respectfully disagree or have a differing opinion from someone anymore. It's you either believe what I think, or you're a horrible human being, you're a bigot, you're whatever else, you're stupid. Like we immediately go that direction, which is funny because like you said, most people are pretty smart, man. Like if you have a dialogue with them, they might have a different opinion, but it's not just because it's a different opinion doesn't mean it's ignorant. It just means it's different, man. And we value different things as people. That's how it goes.
Yeah, 100%. No, I haven't read that paper, but it sounds really interesting. Dave Lauer, you said is his name. I'll have to check that out and potentially even get him on the show to talk about it, because it sounds like something I'd be interested in talking to him about.
Yeah, he's a super cool dude.
One or actually, I don't know, something you were just saying just reminded me of this. I think it was like about how like every conversation has to be like, you're right, you're wrong, instead of having a nuanced conversation. And this has nothing to do with markets, but I just want to bring it up before we get into it. So I don't know if you saw this, but a couple days ago, and for everyone that's new with us or maybe hasn't seen Eric on the channel before, Eric, you're you were a U.S. Marine, correct? You're a U.S. Marine veteran.
Yeah, exactly. I'm still in the reserves now, but not on active duty anymore, thankfully.
So the other day, I don't know if you saw this, but Tom Brady, I guess, in an interview or podcast said like, oh, getting ready for an NFL season is kind of like getting ready to go on deployment or something like that. And people freaked out about it. And I understand
Of course.
why people were upset, right? They're like, all right, here's this millionaire making a lot of money, trying to compare himself to people going to active duty. Like, again, completely understand why people are upset about it. And then he came out and apologized. My point was, I was just trying to make, and people argued with this with me last night. I wasn't saying that I like agree with the comparison or whatever, but compared to 99% of like other jobs out there, me coming to my desk job at Benzinga, whatever, being in the NFL probably is more similar in the sense that you're with a bunch of dudes, like you're working out together. Like, so I'm saying like, that was my only point, was just as far as compared to other jobs out there, being in the NFL probably is more similar to being in the military, but still, like, you know, people were all up in arms about it and mad at him, and he felt the need to apologize.
Dude, people are so self-righteous. Like you have to understand the context behind what people are saying, right? Like, obviously he doesn't think that he's getting ready to go deploy to a foreign country. That's not what he's insinuating. He's just talking about the physical aspect, the camaraderie. I didn't see the interview, so I don't know anything about it, but I feel like people are just so fast to try to jump on somebody else for any broach of their self-value. You know, somebody goes, we get ready to go deploy, and as soon as anybody makes any sort of comparison about that, everybody loses their shit. It's the same thing with like a lot of people freaking out when I forgot the dude's name, but there was the guy that was like kneeling during the national anthem.
Colin Kaepernick,
yeah, that dude. And everybody's freaking out, like, oh my God, people over there dying for your right, and da 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 da. And I get that. Obviously, I respect that. But the entire purpose of the US military is to enable that freedom, that exact freedom. Do I want him to stand? Yes. Do I think that's a respectful thing to do? Yes. But does he have a right to do that? Also, yes. So people just want to get so self-righteous, man, and like freak out about any broach of what they think is the right display of something. It's so frustrating. Just chill the hell out. We're all just people floating on a space rock that's going, we don't know where. And yeah, just relax.
Yeah. And that was what was kind of interesting and ironic, I guess, about the Kaepernick situation, was you had people like yourself who were like in active military who were like, yeah, I don't agree with it. I'd rather see him stand, but I'm still going to put my life on the line so he has the freedom to do that. So we don't live in a country where you don't have the freedom to not stand if you don't want to. And then people that weren't even in the military were so upset by it, you know, whatever. And it's just like you said, we're on a rock floating through space. Why do we have to get all upset at each other about this? But just for this show's sake, let's go ahead and I'll pull up my Benzinga Pro. We'll get to the market. What have you been trading? What have you been watching?
So today is actually a really interesting day on the SPX, really any sort of the broad indices right now, big expiration cycle. So from a derivative standpoint, there is a ton of open interest right now that's centered in today's expiration. So that's nobody knows why anything happens in the market discreetly, in my opinion. I mean, obviously certain catalysts, you can get an idea, but a lot of the market movement that we're seeing today is like very stereotypical of high open interest and leading into an expiration day. So there's a ton of cash that's moving around, and you can kind of start to see some of that unfolding as the day started and as we started moving on. Because as I look right now, there's like 400,000. Let me see. I just did the math a second ago. So there's 252,435 open interest in just today calls in the 370, 375, and 430 calls. And then for the 330, 340 puts, there's 319,311 open interest. So all I'm expressing is the the breadth of contracts that are outstanding and expiring today, those are the highest open interest concentrations that exist. So what's happening is a lot of money is moving around in the market. We're going to be seeing things kind of a lot of covering from market makers leading into expiration because they need to control their inventories. So I already have a bunch of short SPX puts out there. I took a bunch of them down already. Like today is a very productive day. And the other thing I'll note on it is this setup that we're seeing now has repeated the last two primary earnings cycles where we had outstanding open interest leading into that expiration cycle. So what I mean by that is last week we ended on a down week, pretty strong bearish volume leading into the end of the week. And leading into expiration week, we're seeing the same style rebound that we've seen two other times now. Obviously, that doesn't mean it's going to perpetuate into perpetuity, but this is a pretty known phenomenon. I'm not sharing anything that's earth shattering. It's just people that don't watch this stuff wouldn't know about it. But there's a lot of opportunity right now.
So you said you're long puts right now on the SPX?
Short puts.
Oh, so you're selling puts.
Yeah, so I'm short 0 DTE SPX puts. I had anything from, and I sell them normally like an hour, 90 minutes after the market opened, just to make sure that there's not any additional catalysts that I hadn't accounted for. And I started essentially from a 30 delta, 25 delta, 20 delta, down to a 10 delta. And I just sell in essentially even size lots all the way down.
So wait, are they technically like you're selling covered puts? Like, do you have enough money in your account to buy the shares of SPX if they get down to the strike price, or how does that work?
It's a little bit of a misnomer because the SPX, since it's a theoretical index, there's no underlying, there's no volume. SPX doesn't trade shares at all. You can trade derivatives on it, but you can't trade shares. If you wanted to trade shares in the S&P 500, that's when you have to go to something like SPY. And you can get the actual exposure to the underlying itself. But yeah, SPX has no underlying asset to trade. So in this instance, to answer your question succinctly, I'm just trading the derivatives on it, and I'm just using the portfolio margin that's required for the positions.
So your downside, say, you're selling these puts, SPX does reach the strike. Like, what's your downside on those? Is it like a 1-to-1 type return thing, or how does that work?
No, definitely not. When a lot of times when you're selling options, we have obviously fixed profit, higher typical profit potential, slight edge built in, especially when the variance risk premium exists as it does today. Ladies and gentlemen, I'm stoked to say it's back temporarily. But the potential downside is much worse for selling options than buying them. And that's why there's a lot of different ways people try to manage that risk. So you can choose to, my preference, especially for trades like this, is I use sizing. I do not use something like stop limits, especially on a day like today where the market's got some legs on it because there's a lot of money moving around again because inventory is moving. So I use sizing to manage the risk in that strategy. So essentially what I'm doing is the short puts that I'm selling, if there's some sort of catastrophic move, even if it goes to zero, it wouldn't kill me. I wouldn't like it, but it wouldn't kill me. But what I do is I essentially plan for a catastrophic move, and then I would use that as a stop point to exit the trades. But I don't do what a lot of people do, which is either put them in and set a resting order to exit at 3 times credit received or anything like that. I think that starts to kill the source of edge in the strategy, essentially.
Yeah, and I think I've wanted to, I think, dabble with a strategy similar before, and I've worried about like not having enough capital for the collateral to sell those puts or and do stuff like that.
Yeah, and I think that that's fair, and it's like you kind of have to find the right fit, for the portfolio. And I actually think that that's really smart of you, because what a lot of people do is they try to force it. So what I mean by that is, like, if I pull up SPX right now, and it'll be a little bit different because we're pretty far into the day, but let's just say I look at the 3685 short puts on portfolio margin that requires $51,617. So a lot of people, what they'll do is if they can't fit that size in the portfolio, they'll buy far out of the money wings. Not a big fan of that, because really the exact thing that we're selling, because it's expensive, you are then buying it. And really at its most expensive point, further out of the money options relatively, they are more expensive for what they're providing. They're overpriced, and we know this. So you can do that. It's not my preference. If I think that there's going to be some sort of huge catalyst and I know I'm stepping in front of a moving train and I'm just trying to mitigate risk, that's when I would buy a pretty far out of the money wing and just accept the cost. But it's almost only to the downside. So if I was selling short puts and short calls, kind of strangling it, I wouldn't turn it into a super wide iron condor, just because the propensity on the call side is not there for those huge run-ups, especially in the index options. When you talk about individual securities before earnings, completely different story. But yeah.
Yeah. What about if someone was like more from an investing rather than trading standpoint? But what if someone, say, had, you know, 100 grand and they were trying to start a portfolio? Why wouldn't someone pick out the names of stocks they want to own? Say like, okay, I'm looking at Tesla and I want to own Tesla. Instead of just going right out and buying the stock, why not pick a price below where it's at right now that you wouldn't be mind going long the stock and start selling puts, either getting that free money if the stock stays where it is or starts going up, or it goes down to where you would get it anyway and then buy it there? Like, would the downside there be you could potentially be missing out on returns if like the stock's going up a lot and you could have just owned it, but instead you're selling puts now against it?
That's a big part of it. There's a lot of psychology tied into that, because I cannot tell you how often I've had somebody say, oh yeah, I sold puts at where I wouldn't mind owning it. And then all of a sudden, when it trades down to that point and then threw it another 15%, they're like, oh shit, I don't want to own it down here. I wanted to own it up there. Guess what, dog? Like, that's not how it works. Your put's up there. So it's a lot of people think that until it starts to look real nasty. And then all of a sudden they're like, oh, wait, no, I don't want it anymore. So I think that's a big part of it. And then you hit the other part beautifully, which is the risk profile that's associated with it. Now, for me, once you develop a healthy relationship with the way short premium strategies work, specifically against the variance risk premiums that are out there, it makes sense. You just have to understand the landscape. But I think one of the biggest shortfalls is when people say, I'll sell a put where I think I want it anyways, I'll collect the money and I'll be happy if I get assigned. There's not a lot of people that get happy when they get assigned and it falls another 20% below their short put strike. So I think if it's, you know, we have a good understanding and we're like legitimately comfortable throughout that cycle, it can work great. That's what I'm doing right now is, you know, beyond what I'm doing in SPX, I trade the covered strangle. It's one of my primary strategies, even during bear markets, trading it right now. And I'm trading it also in my IRA. And my IRA is outperforming the S&P 500 because of this function, because I am allowing myself to collect premiums. And I'm also very careful about the way I structure these trades so that I do not cap upside potential when I'm assigned the underlying. So right now I have like X number of shares of IWM. That's the ETF I'm using right now, the Russell 2000. And what I do is, let's say if I have 100 shares and I sell one call, well, you just capped your upside. But if you have 150 shares and you only sell one call, you have uncapped your upside because you have 50 deltas that are not covered by that short call. So there's a lot of really creative ways to structure it. Yeah, not to go super far into the weeds.
No, that makes sense. I know we talked about doing some sort of like, you know, intro into options. So there might be some people who, but to me that makes sense, right? Because you have 100 shares. If it was 1-to-1, right, you have 100 shares and you're selling the put, then you, like you said, you have that capped upside. But if you have, your example, 150 shares, you have 50 more shares than the 100 contracts you have. Now your upside is uncapped.
Bingo. That's exactly it. So, and what you're doing is you're just finding the risk to reward profile for you, right? Like in that scenario, what you've chosen to give up is the opportunity cost of the capital that you're holding in the extra shares. And then you're also, let's say if you had 200 shares of the stock and you only sold one call against it, you're then also giving up the opportunity to receive that premium upfront, a known good. But the payout for that is unlimited upside potential. So it's just about constructing trades that make sense based on, the broader strategy. I think using short puts, especially cash secured puts, as a way to enter an underlying is really smart. I think most people lose the discipline when things start going sideways and their disposition changes because they're going sideways, because they just looked at it up front and think, wow, this looks great. I'll get paid to buy the stock. How awesome is that? And you just got to dig a little deeper than that. And otherwise, it's a great strategy.
Yeah, and like your example, I mean, I have the Netflix pulled up here, and it's like, at when Netflix was trading at around $700, it's like I could have been selling $300 puts, saying, "Oh, I wouldn't mind owning the stock at 300," and then right when it gets down to 180, saying, "Oh, I don't want anything to do with that stock, especially at 300." So that makes a lot of sense. Kind of, you think, "Oh, I wouldn't mind owning the stock," and then what do you know? Once it gets down there, it's like, all right, the sentiment has changed with the price. Now
Right there.
now you don't want anything to do with it. So, so you mentioned kind of how you're trading or going into, are you going to trade any individual names around earnings, or is that not something
Yeah.
you
So this
typically
week
do?
was actually pretty busy for me for individual earnings. So I'm pulling up my little tracker. There was a handful of stuff I did. I did Johnson & Johnson, UAL. I passed on Netflix. What I do is I have like an Excel sheet essentially where I track the previous 16 earning cycles. And I look at the earnings numbers, how the underlying moved around earnings, how volatility changed, because I'll trade derivatives around earnings. And Netflix has been exactly what everybody expects Netflix to be like. It's just a freaking wild card. So I skipped on Netflix. Then I traded IWM. I traded Tesla. I traded American Airlines. I traded AT&T. I traded CSX. And then I also traded Verizon. So this week was a little busy with individual earnings, and it's really tied to a couple things, but the main one is I'm starting to see good risk to reward profiles based on, again, just the variance risk premiums. That was a big bummer for a while because a lot of the short premium strategies, they wouldn't do so well when VRP is very low. It makes it difficult to find any volatility edge, and then you're dependent on direction alone. Whereas with a lot of these binary events and the normalization of VRP, we're getting more opportunities. So this week's actually been super productive. This is probably my biggest return week so far year to date. It's probably like 3 or 4% on the portfolio, I think, right now.
On the week?
On the week, yeah.
Hell yeah, you do that week in, week out. You'll be running the biggest fund in Wall Street.
Yeah, it sounds good, but yeah, that's why I said so far year to date, because year to date's been really slow. I think before this week, I started scaling into the market a little bit more because I've been very hands off. Like all year, I think the most I've been invested up until this past week was like 20%, if that. I've been sitting mostly cash doing box spreads just so that I'm keeping some money coming in. But since I'm getting closer to the end of the year, I need to start getting closer to my benchmarks. I think beginning of this week it was like 8.5% year-to-date return, which is good, but it's still not where I need it to be. So this week I needed to start getting a little bit more aggressive, which so far has been working out well.
Yeah, and I mean, there are always times where it's a good time to be holding cash, and there are times where you want to be deploying that cash. And I think we are, like you said, getting to that point where it is time to start, potentially putting some more risk out there and just saying, all right, look, like, do I really want to be, just sitting on cash now after doing so for a full year or whatever? But yeah, I'm 100% with you, man.
Yeah, and I think you hit the point, like the nail on the head right there. That's an important point. Is I was actually talking with a few other traders last week about this, and we feel like, oh well, I just need to come to cash and wait for something to happen. Normally, it's whatever we think should happen. Something should normalize, and then it like never really normalizes, and then all of a sudden you're looking back and you're like, okay, I've been sitting on cash now for 6 months. Nothing is happening. The only thing that's doing is my money is decaying because of inflation. And you kind of get to the point where you gotta do something. It's, for me, this year's been more of a tester year because prior to this year, my objective had always been 15% return on the portfolio per year. Nothing crazy, But I've been very consistent in doing that, and it's served me well. This is the first year that I've actually started backing off of that goal. And instead of going for 15, now I'm pursuing 12% per year. And it's mostly because I'm generally interested in partial income generation and slow maintenance of the portfolio as compared to the growth I was pursuing before. So I'm still even getting a feel for how I want to deploy the portfolio, especially in this kind of market. It was two things coming together at the same time, but can't sit in cash forever.
Yeah, 100%. I mean, cash, was a great position to be in the past 12 months. I don't think it'll be the case the next 12 months. We shall see, though. Eric, it is about 1 p.m. Eastern, which unfortunately means it's time for us to wrap the show. But as always, pleasure getting you on the show. I'm going to go ahead and drop your Twitter in the chat at ESInvest to go follow Eric. And then, yeah, man, let's chat next week about some setting up a more put together kind of content plan going forward. I'm excited about that.
Yeah, for sure. That sounds fun, man. Thanks for having me, and enjoy the rest of your week and weekend. I'll catch you later.
Will do. You do the same, Eric. Enjoy your weekend. Thanks again for hopping on Benzinga Live. Everyone smash the like for Eric. Talk to you next week, Eric.
See you, brother.
Bree show quick. What does that mean? Oh, the show was quick today. Yeah, we had all access. Go to 12 o'clock. I thought you weren't even hanging around, Shy. I thought you said you were just popping in to say what's up. But thanks for hanging out with us. Hope everyone enjoyed the show today. Please smash the like if you have not already. Stock Market Movers with Money Mitch coming up right after this. This stream will redirect you to Mitch. You do not need to go anywhere, so stay tuned. Do not touch that keyboard, mouse, clicker, wherever you're watching, wherever you are in the world. Stay green. Stay happy. Hope everyone has a great weekend. And we'll be back next week. Love you guys.
This is Benzinga Live.